Hello, everyone. I hope you're all doing great wherever you are coming from the world. Welcome to this online panel discussion focusing on exit strategies. It is part of our online content platform called The Core. My name is Thomas. I'm the head of the startup and investor communities at Hello Tomorrow. So for those of you who don't know us, Hello Tomorrow, we've been active since 2014 in the deep tech space. We're organizing events and we're connecting the best deep tech entrepreneurs with corporates, with investors, accelerators, public institutions, and so on. And our way to do that is mostly through our annual competition called the Global Challenge. And today I want to announce a big news because we're opening the call for application for the 8th edition of this Global Challenge. We've received more than 20,000 applications over the past 8 years. And for this edition, the applications are open until the 23rd of September, and there's 150,000 euros of cash prizes to win, a lot of coaching connection opportunities with our network of hundreds of deep tech investors, of corporates. There's a lot of visibility to gain and to pitch in front of this amazing audience, particularly during the next edition of our annual event called the Global Summit, which will be in March 2023. So if you want more information, just head out to our website, to the Global Challenge page, and you can find all the information and apply there. Back to the matter at hand today. We're really happy to be organizing this session on exit strategies and on why it's good to plan early. We have an amazing lineup of speakers, both from the investor and from the entrepreneur side, to share some tips, to share their experience on exits in various countries, in various industries. So it will be really, really interesting. Just to give you a few info on how to use the chat on the right tab. So you can start by saying hello, by saying where you're from, and then you have a question tab where you can ask all your questions for the speakers, where you can upvote the questions that you like the best, and we'll ask the questions to our speaker towards the end of the session. I think that's all on my side. Now I will leave the mic to our great moderator for today, Renita Kalhorn. She's an executive coach and advisor, and she's also a freelance writer for Forbes. So Renita, thank you very much for being our moderator today. I leave the floor to you to introduce yourself and our speakers. Thank you.
Thank you, Thomas. Thank you very much. So in the 7 Habits of Highly Effective People, Stephen Covey says, begin with the end in mind. Meaning whenever you begin something, start with a clear vision of your desired direction and destination. Now, when you're dealing with the day-to-day challenges of building your company, and there's so much that's uncertain and out of control, having an exit strategy might not seem like a priority or even possible. But having some idea of your preferred exit strategy is actually very important, because once you take VC funding, you're agreeing to work towards an exit, whether that's an acquisition, an IPO, or some other means of returning the capital. So you don't want to inadvertently limit your options down the road. And so when you have some idea of your preferred options, it can serve as a compass or a blueprint guiding your business strategy and even the overall direction of the development of the company. So as Thomas said, today's panel discussion is the perfect place to start. Our guest experts have experience across the board as founders, VCs, corporate VCs in Europe, Asia, US, and in various technology sectors in biotech, energy, and sensing. So let's meet them now. So Bastien, let's start with you. Bastien brings a wealth of experience in venture, private equity, and project finance to the panel. He's 2 postgrad degrees in finance, 16 years investing across Europe and North America, 20 direct investments, and 10 successful exits. And I counted on your LinkedIn profile, he's a board member of more than 12 companies. So obviously a breadth and depth of experience in investing. So Bastien, in 2020, you joined Alantra Energy Transitions as a managing director. Could you tell us a little bit more about your focus there and anything else you'd like the audience to know?
Sure thing. So I guess those impressive numbers are just coming from the fact that I'm sort of old already. So, and I've been doing that for many years, but
Still counts.
that's the main reason. So yes, we set up shop with Alantra back in September 2020 with a few other folks. So we're 7 in the team. It's not just me, of course. Most of us coming from energy investment background, so our fund is very focused on energy transition technologies. So more the venture part, sort of late stage, early growth. So we usually are part of the exit, right? Hopefully, and we take minority stakes in companies in North America and Europe, sort of 80-20. And in all cases are pretty active, not just at the board level, but together with the management team in order to help them grow the company and potentially successfully exit it. That's it on my side, I guess.
Okay, well, we'll certainly have a chance to dive in further. Thank you. So Michelle got her PhD in electrical engineering from University of California, Berkeley. She went on to found and successfully exit 3 startups, one of which was acquired by TDK, the Japanese electronics multinational. And in between founding companies, she also worked in M&A and strategic investments for public companies. And then last year, she co-founded a VC firm, Impact Science Ventures, which gives you, there's some clue to what they're doing. But Michelle, would you like to add anything that I missed and tell us a little bit more about Impact Science Ventures?
Yeah, absolutely. Yeah, thank you for the introduction. So yeah, I think you called everything pretty much. It's a good outline, and as you said, as the name implies, it's not very subtle. So our fund invests in early stage companies that's based on the fundamental science breakthrough innovations, and that has the potential to solve really big problem in the world, and that will include climate change and sustainability, etc. So that's the first fund that I co-founded after moving into venture capital, after sort of 20 years in operating role, as Bastien says.
Right. So you're at the beginning of it all. Excellent. All right, Alex. Alex has an MBA from INSEAD and has been working in the pharmaceutical space for over a decade. He spent 9 years at BCG, where he was part of the global healthcare team focusing on pharma and medtech. And then in 2017, he co-founded PhagoMed, Biopharma, a biotech company developing phage-based pharmaceuticals to treat bacterial infections. So Alex, clearly we're going to be diving into how PhagoMed was acquired by BioNTech, but is there any context you'd like to share on how you as an MBA came to found a biotech company?
Yeah, it's certainly maybe not the standard path for an MBA to take, but in my case, I think there was very early on an interest in the antibiotics crisis and the fact that antibiotics are becoming less and less effective and bacteria more and more resistant. And I got in touch with my father-in-law on that topic, who's a surgeon and who had been experimenting with new antibacterial agents, and then met a colleague of mine at BCG who's a molecular biologist and who actually understood something about the science behind new antibacterials. And so then the 3 of us had a shared passion around the antibiotics crisis and this idea of, can we design new antibiotics that are much more precise and that really eliminate a single pathogen from a microbiome rather than destroying the entire beneficial bacteria that we have. And sort of that led us onto a journey to found a company in 2017. And then much earlier than expected, last year, we had an acquisition offer on the table that we felt very positive about and that ultimately we took. And so since October, we now get to continue our science as part of BioNTech.
Okay, well, certainly we'll be diving in further. And actually, let's start with that. That most likely exit route for many deep tech startups is going to be acquisition or a trade sale to a corporate buyer, because even if you're targeting an IPO, you're still probably going to be navigating those acquisition offers on the way. So let's start with you, Alex, since you're fresh off this acquisition. Could you take us behind the scenes of what happened? How did this come to be? And maybe what you considered earlier on to set yourself up so that you could optimize your options.
Yeah, so maybe, I mean, starting a company out of a very secure job, which is management consulting, did require us to have a big faith in the fact that we can create value, because otherwise the opportunity cost of leaving would have just been too high. And sort of from the beginning, we tried to think through what is the product that we're developing, which market could it address, and why would it ultimately have a space in a market to succeed commercially. And given that we're developing a drug that takes a huge amount of investment to go through clinical trials and make it to the market, every person you talk to from day one asks about the market potential at the end. And so having that ready was very important, and it allowed us to take some good decisions around where to focus and where not. Now, the discussions with BioNTech started on a purely technological basis. We had found some overlaps between our technology and their technology that we wanted to explore. And that set us off on the path of talking about potential collaborations, which then fit into the time frame where we were raising our Series A. And that sort of then turned into a discussion around participating in our Series A. And then that sort of snowballed into an acquisition case, which is maybe typical for many actual exit scenarios in which you start a discussion which is more technology focused, but then you discover so many overlaps that suddenly an acquisition actually makes a lot of case, and that's a lot of sense, and that's certainly what happened in our case.
And you saw the possibility emerge, it sounds like. Michelle, what about you? You had 3 successful exits. What is there a particular story you'd like to share in terms of how you approached thinking about your exit strategies?
Yeah, absolutely. So as Renita, I think again, right, I feel that you really sort of gave a nice background and explanation about why you really want to think about exit strategy from day one, for a variety of reasons, because a lot of things that you maybe initially doesn't think that's important, but not when it comes down in negotiating or finalizing the deal, sometimes it becomes somewhat important. And also the other thing is, as you said, particularly in the deep tech space, even though there are company who ultimately grows very large and end up going public or either directly or through SPAC, but still most of the deal tend to end up through MMA as an exit, and which is not to say that that's like a worst option, but it's as sort of conventional as some people might have thought, but it's actually oftentimes a very rational way of sort of either getting liquidity or just kind of growth and scale your business in a way that's not just through venture capitals or through public market directly. So I guess in terms of how do you think about strategy, and then the other thing is just also like you want to think about potential acquire early, because those tend to be relationships you want or need to cultivate over time. So as Alexandra's story as an example, and then also similarly for my own company, for example, the last one I sold, Chirp Microsystem, that was sold to TDK. It was also a relationship. At the beginning, completely nothing about acquisition, especially TDK was not. So Chirp was making ultrasound sensor for different applications, and then TDK has some business in that space, but not wasn't a core focus. But But it's just a relationship. I started early on, and then there was a conversation, and then they are interested in the technology and the space in general, and then ultimately, kind of at some point, there was an opportunity for them, or they decided in terms of corporate strategy, they want to like make a big play in sort of this MEMS based sensor space. And then started acquiring company, and then so our company became like one of the top targets as a result, and then eventually happened.
Yeah, let's build off that just a little bit. What are some of the reasons that potential acquirers might be interested in acquisition? Any of you have some thoughts on that?
I can take the floor since my peers answered the first two questions. I guess again in our case, and we are investing in technology, so the main route to market on the exit side of things is M&A transaction to incumbents from the market. So what I'm gonna say is true for M&A transaction, right? Selling to the incumbents. I think the first thing they're buying in is definitely a technology together with a customer, a portfolio of customer, right? It's fine to have disruptive technology. Okay, that's good, but there is the exit is much more compelling in terms of multiple if you also have a commercial proof point that you can generate revenues out of it, right? And commercial revenues, not just pilots and stuff. So if you can say, okay, my technology works out there in the field, whereas it is a software or hardware, and there is a portfolio of customer I already have, and then you can leverage my technology to sell to your customers, etc. Then you get the strategic value, right? You get the extra mile on the multiple, because then the buyer is buying a technology, but not just the technology, he's also buying the belief that he can also sell that to his own customers, right? Portfolio. So I would say the buyers are, yes, interested in technology and completing their sort of a portfolio of tech and services, but it's also they're buying the potential, the upside in terms of commercial. I mean, at the end, they need to grow their revenues in a sound manner, right? With financial returns. That's the ultimate goal anyway. So that's what they would value is, okay, I'm buying the tech from you, but I need to be able to believe in some EBITDA consequences at my level, right?
Right.
That's
so it sounds like they're buying speed as well, because instead of having to build everything internally.
Yeah, of course. And to be honest, the first reaction of a big corporate is always to say, okay, we can do it internally, right? And then after a few years, they realize, okay, I'd rather buy someone. And
Let's
then
go
this
shopping.
is when you should be ready to sell, right?
Yeah.
Not before, but indeed, yeah, it's very often the case that at the end you end up buying outside and not building inside.
Alex, is that what you found in your case? Or is there some nuance?
Well, yes. The nuance is that in biotech, you don't have revenues initially because your time to market is just so long that ultimately most exits happen either at the early clinical stage or at the later clinical stage, but typically before you actually come onto the market, which is when you want to benefit from the marketing muscle of the big pharmaceuticals. But I think what is true is that oftentimes acquisition happens when there's a gap in the portfolio of a company. In the case of BioNTech, the vision is to tackle the biggest medical problems out there. And certainly the antibiotics crisis is one of those big problems. And it's an area where the existing technologies that BioNTech had just didn't include a large antibacterial toolkit. So in that sense, we complement the portfolio and bring something into BioNTech that can hopefully synergize and help address and create new drugs that ideally become even better than what we could do on our own or what BioNTech could do on their own.
So it was like that perfect synergistic combination of your competencies.
Well, that and simply a gap in the portfolio. If we want to develop, we want to solve the medical problems of tomorrow, and I think obviously the corona vaccine is a great example of solving a medical need that emerged, and the antibiotics crisis is a similar pandemic that's sort of slowly and silently progressing. Then yes, we need to have a toolkit that's available to address pathogens that either become resistant or that are difficult to treat in the first place.
Got it. Michelle, anything to add?
Yeah, so I think that, as I mentioned, I gave an example about the reason why TDK were acquired as an example. That is, a company, some of the companies, if it, like Bastien says, some company, at least maybe initially the R&D people would have the attitude of, oh, it's better, we can develop it ourselves and rather than acquiring. But sometimes either later on they figure out it's not that easy, or just like take too much time or more capital to get to it. And whereas in TDK's case, and it's similar to like many other potential acquire, acquisition sometimes is a way for them to get into a new place that they were just either adjacent to their core business that they want to expand into, or it's really almost like a new direction for them to focus on. So yeah, as I said, in TDK's case, they've been in they are in the sensor business, but with a more conventional way of making sensors, including ultrasound sensors, but sort of a MEMS-based, a semiconductor-based sensor is a new space that they believe would provide a tremendous growth for kind of the next phase of the company, just much like how they've grown or kind of over time transform the company. If for those of us who's live long enough to know TDK used to be known for their sort of cassette tape business. And maybe the younger generation will go, what's cassette tape? But so no, they don't sell that anymore, but they transition into different industry over time through acquisition. So currently they're a majority or probably potentially over 50% of their revenue actually came from battery, unknown to many people, and which was also through acquisition. So sensor was kind of their next kind of area of they see as a big growth area. So and there are many other companies have that similar reason for acquiring companies.
Right, got it. So I mean, you all bring up this point that technology is something that can enable evolution and transformation for companies, and then on the other side, technology can be applied to multiple problems. These deep tech technologies. So how should deep tech startups think about this? Should they be homing in on specific markets? If so, how do they identify the customers that might have the most commercial needs? How should they think about that? Bastien, do you want to start?
I guess it depends a bit on at what stage you are in the development of the company, right? If you're at the really beginning and then you're still trying to solve for the science, then just focus on that, right? But at some point, if you have it more or less up and running, then you should start indeed on thinking about, okay, who am I going to sell that to? What are the use cases? And as you mentioned, specific technology can be applied to multiple use cases. I think there is a time for exploration, and it should be sort of seed Series A, right? In Series A, you explore one of two verticals that you feel like gut feeling wise are the most promising wise. But you should also think timeline, right? It's sort of, okay, this is very promising, but it's 10 years down the road. But it could be huge market. So what is my sort of secondary market that I can sell into now and not in 10 years time? But then potentially at the exit, I'd be valued on this for sort of first bigger market, right? So you want potentially to have 2-3 use cases you focus on with different timelines and probably different market size. But don't go into too many use cases, right? Because from a venture point of view, it's like, okay, you guys are 10 people. How can you address all those use cases at the same time when you're also solving for the technology, right? That won't happen.
Right.
That won't. So
do you have an example of a startup that you've worked with or maybe even observed where they had that dilemma of how to decide which use cases to focus on?
Yeah, I guess it's always the typical stuff in Series A, right? I wouldn't put names on the table because I don't want to give away names on people doing bad things. But it's always the case that the at Series A level, they say, "Oh, we're selling it to that market, but we can sell also in this one, in this one, in this one," and then said they have like 10 slides of potential use cases. And the feeling you're giving to the venture team in front of you is that actually you don't really know your market because you have so many use cases that it means that you didn't explore any of them, right? So you might want to be more focused on 2 or 3 and being able to talk about them, to put customers on the line when the venture fund is doing its DD calls, etc., to sort of prove that, okay, I've been exploring those use cases for real, right? It's not just some thoughts on paper and then random market numbers, right? So that there's it's typical mistake at Series A level that because you want to prove that your technology
Show
can
the
address
potential.
a gigantic market, right?
Right.
You're adding up use cases. And,
yeah, that's right. That's psychology.
Yep.
Alex, I get the sense that your path was a little clearer, but is that so? How did you focus?
Yeah, I think that it actually wasn't that clear in the sense that from the beginning we a bit by accident worked with 2 related but slightly distinct technologies. So one was we were using the complete phages, which are viruses that infect and then kill bacteria. And then we were also using phage-derived proteins, which break open the bacterial cell wall. So both achieve the same result. They both kill the bacteria, and they're both reasonably precise, meaning they kill a specific genus or species of bacteria. And it was by accident that we were working with both because we couldn't find a phage for an indication that we were interested in. But then as the years progressed, we sort of kept asking ourselves, well, do we continue with both? Which is obviously complexity. You need a slightly different manufacturing processes. You have different modalities around them, or do we focus? And we always tried to find proof of concept models, scientific models that would help us answer the question, which of these is more effective and has a better chance as a drug. And in 2020, the choice became then quite clear. Also through the advice of some of the mentoring programs that we had, that in reality, one of the 2 technologies is just superior. And so at that point, we had to pivot and sort of select one of them. And that ultimately was the right choice. So I think it's always a balance between, I think it's good to have a bit of diversity. So in our case, if we had just bet on one technology platform, that would probably not have led us to successful exit. If we'd just stuck with the phages, that would not have led us into the BioNTech acquisition. At the same time, too much diversity is obviously also harmful because you only have so much money, so much capital, so much people on your team. So that also for us, the moment we were able to focus on one technology platform, it was actually a huge speed driver in our development because the whole team was able to focus on one path. So it's always that balance. Yeah, too little diversity means if something happens, that's it. Too much diversity is you slow down everything by diluting your effort too much.
Right. So clearly there's no one size fits all or here's the way to do it kind of answer, but you are saying, this is something you need to be calibrating and be aware of. So hopefully that alone, that awareness is helping people. Michelle, what about your experience from, working in corporates where you're looking potentially for companies to acquire, or on the other side when you were building your companies?
Yeah, absolutely. So get me going back to like the beginning of the question, it's just how do you like find that the biggest problem to focus on that has the greatest need, and that is just by through talking to all kinds of people, everybody up and down the supply chain, but. Actually, when I say talking, I really meant like listening, right? But having engaged in having a conversation with a potential customer, ecosystem, like partner, channel partners, or even potential competitors, and also company in adjacent market, and really listen to what people are saying, and that's how first of all you kind of figure out the right market for your technology. And then as like how do you like really prioritize or identify, because this is oftentimes for deep tech company, multiple application use cases or market vertical we can go after. So I usually think about it as an what we call the beachhead market versus a potential different like longer term the ultimate market. By that I meant especially if for a venture funded company, right? You do want to relatively quickly sort of establish a presence in the market, because that really started shipping things is really kind of a major milestone from having prototypes or even like concept initially, but having prototype in the lab is still quite some ways away from having commercial products. So identifying that beachhead market, and which is usually an area that people have really just very compelling needs, and then potentially not having any viable solution, or just what's existing is too expensive, etc. So that's an area where you'll find more easily find early adapter, company willing to buy things from startup companies essentially, but that helps you to kind of establish a presence and also really kind of work through like this whole commercial process for your product and for the company. So you want to find that first, and then really focus on that at the beginning, and in the same time having this roadmap in mind, which is important in terms of help you to design, right, and also kind of really structure how you would scale, grow and scale the company business going forward. And this is also important that to have that vision, because when you're raising money from VCs, so again, take my company as an example, the last venture, for example, like we identify as VR, AR being one of the beachhead markets, because the technology for a good tracking technology is not widely available, and that's really such a new market that they are very willing to try out different new technology, as well as working with the untested startup companies. Whereas the longer term the vision is to go into like more broadly consumer product, and then eventually maybe automotive, which will take a long time. So a lot of times there are company having technology that has great potential application in automotive, but it takes really long design cycle to get into it. But once you are in automotive, oftentimes it's really it becomes quite a stable market for long term. So for those companies, I tend to would advise them to like look for alternative market for your technology first, that you can enter first and really help you to kind of flesh out the everything, and then in the meantime, sort of building up to selling to automotive as an example.
Right, got it. So I mean, the thing that stood out for me is like just coming to back to the basics, having conversations with potential customers, potential suppliers, just so that you're not working in this vacuum, developing something that ultimately isn't going to be aligned with a need. Just as a final quick question on that, and this is actually a big question, so just some quick ideas you might have on how do you maintain control of your intellectual property as you're going through this process, either through partners or potential discussions with potential acquirers. Any thoughts just to be watch out or be careful of these mistakes? Anybody?
In our case, there is indeed IP in most of the companies we're investing in, but I wouldn't say is that critical as in biotech, for instance. Hence, and then also sort of knowledge and sort of operational solutions are also sort of part of the secret sauce, right? Not just the IP. So in case, I mean, the IP is indeed protected with proper patent, etc., registered in the main countries across the board, but I would say the entry barrier is not necessarily there as in the biotech. So it's less critical to us to protect it, and potentially also less critical for the buyer, in the sense that if it's running, it's good enough, right? I mean, if the product work is good
It's
enough,
very
they don't
obvious,
need
right?
necessarily to know that the IP is one way or the other.
Got it. That makes sense. Alex?
Well, you have to have patents. I mean, in biotech, I think that's pretty clear because you ultimately want to bring a drug to the market, and the patent lifetime will play a huge role in the value of that drug. But having said that, once you have patents and once you feel you have a strong patent position, it's also quite easy to share what you have because it's patent protected. So it then again goes the other way around. I think typically what you can expect, even if you're negotiating with a large company, that you open the treasure chest in the same pace as the negotiations continue. So we had a non-binding term sheet in place before we sort of did the full deep due diligence. But then deep due diligence really means you might go down to every single experiment that you've done in the lab, and you will need to open up obviously quite a lot before the ink is dry on an acquisition agreement. Having said that, I think that's normal, and I think that's also something that for us, we were lucky that at some point we had really experienced biotech veterans come on board who immediately spotted that we had not been, so we had been very good at documenting the experiments, sort of the basic foundation of our knowledge, but we had not been so good in accumulating that knowledge into so-called development reports, which is what you then use to go to a regulator, which sum up sort of parts of your knowledge. And they spotted that. And so we actually spent a month for our team in early 21 where we put everything on hold and just wrote up the development reports that have been lagging for 1.5 or 2 years. And that really was very important because once sort of the acquisition discussions hit, that really helped showcase the depth and the rigorness of our science that we have done. So you have to share. There's no way around it. If somebody's buying, they want to know what they're buying. But that's why it makes sense to protect your intellectual property beforehand.
Right, and being strategic about the timing, sounds like. So speaking of timing then, once you have an offer, so you've done things well, you've got these clients that you're working with, your technology is out there in the field. Once you have an offer, how do you determine if it's the right time or not? Bastien, let's start with you.
Yeah, so that's, I mean, first of all, if you have a buyer, be happy, right? Because it's not happening every now and then. It's like probably once every 3 years. I mean, in most of the cases, to be honest, I mean, that's just my experience, but it is not that often that you have two buyers, right, at the same time.
Right.
So when
Wouldn't
you
that
have
be
one,
nice?
just think it twice before saying no. But in some cases, you might want to say no, especially in the early days, right? Because maybe you're giving away a lot of value that you could build yourself with a little money from venture, and then sell after and be in a stronger
Could
sort
you
of
explain
bargaining
that
position.
a little bit more in terms of where do you know where the value?
But again, maybe coming back to my point of, well, it's biotech I wouldn't comment on, but I guess it's a bit the same also at different stage, you get different pricing, right? So if you get to the next stage, then maybe you're worth more than the money you spent, right? So in the meantime, but in our case, if you have the technology, or if you have the technology plus 10 million euro of commercial revenues from commercial clients, you're worth very different numbers, right? It's maybe if you have the tech up and running, in our case, maybe you're worth 2x the money invested in the company, and I'm just making up the numbers.
Sure.
But if you can also associate 10 million euro of customers, then it's more like 5-6x
So exponentially
the money
different.
invested, right? So you might want to take a bit more money, dilute yourself and the rest of shareholders to get to a much bigger pocket of money, right? So I mean, the first answer is there is no answer. There is no right or wrong, right, on timings. The second is you don't have that many options to sell. Sorry, it's not a liquid market, right, by definition. So you need to go out there and find buyers. Also, that we mentioned at the beginning. It is often that a buyer acquires a company because they know it for like 2-3 years, right? It's not like a buyer is gonna pop up. You don't know, they don't know you, and they're gonna buy you. That's
right.
that's
They're not
very
scrolling on
unlikely.
Instagram finding deep tech
Yeah,
companies.
not really. Hopefully, it would be the case, but I'm afraid not. But nevertheless, so basically, I'm saying if you have a buyer, saying it twice before saying no. But nevertheless, if you are in the early stage of development of the technology, etc., and you have your shareholders backing you for going to the next step, and that collectively you say, okay, we are happy to say no to that offer because we believe there is a bigger price down the road, then potentially you should follow that route, right, and not give away most of the value upfront.
Was that your experience, Michelle, with your 3 exits? I mean, and then also, how did you get advice, or did you get advice on the timing and, you know, an objective way to look at the process?
Yeah, it's a good question, and as I sort of agree with a lot of the things that Bastien says. Although I also have sort of a counter example, sometimes. But so, as he said, right, there's no like one answer in terms of what's the right timing. But the way I see it is that it's usually the best time. Maybe it's easier to think about the best time or best way to sell the company, right? It's certainly like you don't want it to be a distress sell, right? So certainly you don't want to be like, oh, when you are like close to running out of money, having trouble raising capitals, and that's when you start to scramble and look for, well, who can be the potential buyer. And then in that case, some company would maybe like have to retain investment bankers and start the process. And then sometimes even literally it's considered an auction, which we have participated at when I was at Neo Photonics. So buying company, we were definitely more on the value side. We definitely look for a lot of, especially at that, in that period, so the late so 2009 to 2010, or when the sort of the venture capital market is not necessarily the best time. That's when can find a lot of value. We made some great purchases that just turned out to be like enormously, profitable from the company perspective, but not necessarily the best for the investors or sometimes the people who worked at the company. So first of all, right, you want to sell, when you are in the strong position, and that's usually when you have just reached certain milestones. It could be early. So again, right, different point of the company, evolution. There are different opportunity that may present itself as an inflection point, and for potential acquirer to want to approach you, and also sometimes it could be a different type of acquirer will want to buy. So like again, early stage company, or I should say, kind of deep tech, hard tech company. Oftentimes, when you have first initially sort of proven that the technology is commercially viable, either through having started shipping some like samples and whatnot, and very close to or have already gotten a design in, even though you haven't actually scaled up your manufacturing capability, and that oftentimes is an attractive time for the buyer as well as for the company, because you haven't like raised that big round for you to scale up your manufacturing operations, and which again is the case for my last company. The last company I sold, Short Microsystem, is exactly at that point when we were actually trying to raise the next round when TDK came along and made a good offer. And that could potentially be a good sort of win-win situation in that, because that once you raise that big round, then essentially, first of all, you would get diluted even though so at the higher right valuation, overall valuation of a company, but you get diluted. And then also at that point, the investors, especially the investor who had just put in money, would not want to sell the company without, usually, right, that just assume venture capital will want at least 5x return or not, even if it's only just a month after closing. So basically, you kind of, once you raise that big round, essentially you sort of remove that opportunity for being acquired for a period of time, right? And then, but then that's with the goal or hope that you would substantially increase your value until you reach that next inflection point. But that has risk. On the other hand, that's trading off. Then maybe you become 10x more valuable by the time you want to raise the next round. So yeah.
Right. So Alex, you mentioned that you were heading towards Series A, and then this offer came along. So what are your thoughts on how that played out?
Yeah. So I mean, we essentially, I think, as Bastien said, I mean, if you have one offer on the table, that's already fantastic, and I can tell you, it feels really good, and you think hard about that, yeah, and I think you should. In our case, we had a 20 million plus Series A on the table, and we had an exit offer, and it was exactly that debate that we had. I think ultimately there were three reasons why we chose to take the exit offer or to sell our company. I think one was that we saw a technological combination that could create more value that we could alone with just our technology. And so saying no would also mean closing off certain technological avenues that were just too interesting to pass up. The second one was that in biotech, particularly, you play a very binary game in terms of risk. You conduct clinical studies and they either work or they don't. If they work, fantastic. You've created, 5, 10, 20x in value. If they don't work, you've essentially lost that whole program or drops down to maybe 10% or something. So from a risk perspective, how likely was it that our clinical trials would succeed? And now as an entrepreneur, you're always bullish. You believe that you hold sort of the best possible drug in your hands. But even as a bullish entrepreneur, you would give yourself maybe a 60% chance to succeed in every trial. If you need to do 3 or 4 trials, the risks start stacking up, and there's a lot of cases where you end up on the losing side. And then I think the last one is, can you get to I would say, to a fair offer on the table that sort of both sides feel comfortable with? As an entrepreneur, you will always want more. As the acquirer, you will always want to pay less. I think that's normal. But can you get to an offer that you consider fair? And in our case, we considered the offer to be fair. We considered that there was a big risk ahead, and also obviously the actual valuation you need to reach to make up for that safe case, given the dilution is much bigger. So not only do you need to be as successful as you want to be, you need to be tremendously successful because you're diluting yourself massively as the founders in that process. And definitely a big Series A kind of does that. And then also from a technological standpoint, it just made a lot of sense to go together.
Yeah, got it. Thank you. Okay, so I see a question here about acquisitions as opposed to IPOs. Let's see, Vasco asks, how do entrepreneurs/startups stand on acquisitions as opposed to an IPO? What convinces them to part with their own company and to sell it to another instead of continuing on their own journey? So maybe we can take that, and then also if you can comment on IPOs are generally less common for deep tech companies. It's probably just a matter of time. How do you see that landscape evolving over the next 10 years?
So maybe I can take the first part from an entrepreneurial view, and then I'll pass it on to those doing the investment side. So I think for IPOs, there are two things that I discovered. I think one is it is an exit of some sort, because some people in your cap table will want to leave for an exit, and so it is a big change that happens. And at least for someone on the table, it will be an exit event that's happening. And so that's one. The second one is, if you do an IPO and you want it to be a successful IPO, you really need to be convinced that you have a lot of positive news flow that's happening afterwards. And certainly in the biotech space, that's really difficult because you're dependent typically on one clinical trial. And if the result is not perfect, that puts you in a tough spot in terms of your stock price. And then the third one is, at least in our case, an IPO or a trade sale in no means that we're out. Yeah, we're still very much there with a strategic buyer, where typically the founders are very much locked into the company and kept happy through earnout provisions, through multiple different elements, because I mean, you as the founder want to stay on board at least for a certain period of time. You want to see how your science, your technology plays out, and I think, as alluded to in the question, you don't really want to give up what you've built up over time. But then on the other side, the strategic acquirer typically needs the management team to stay in place to really allow the technology to add value to the acquirer. So I wouldn't consider it as black and white in the sense of I sell and I'm completely out. At least in our case, and that's public knowledge, is there's a certain earnout provisions in there that are a substantial part of the purchase price. And so also rationally, it makes total sense for me to be here and to continue working and to continue to do great science with our team, because it's for the mutual benefit of both us as sort of the exiting owners and the new owner.
Yeah, well, that's what I've gotten from your story, Alex, is that it actually opened up new possibilities. It expanded your ability to build great science. So you're not, in the question's words, parting with your own company. You're really just being given more energy, more fuel to do what you already were doing.
Yeah, and I think in biotech, I think the realization is, and obviously BioNTech is the outlier, but very few biotech companies at the end commercialize their own product. Why? Because you need to build up a sales force, and even BioNTech needed to partner with Pfizer to make the vaccine as commercially successful as it is. So in biotech, you start a biotech with the assumption that you're going to either out-license or sell your drug. So maybe that also made it a bit easier for us to then consider, partnering with a I'll call it a big pharmaceutical company, though I think technically BioNTech is more like a medium pharmaceutical company. But it made it easier because it was clear that for our drugs to be successful, they need to end up in the hands of somebody with the muscle to bring them through the very expensive late-stage clinical trials and then onto the market and into the hands of physicians and patients.
Yeah. Bastien, you had mentioned in one of our conversations about liquidity. Do you want to share some of those thoughts?
Yeah, maybe taking initially the entrepreneur's view and then the financial investor view on IPO. To be honest, for having been in companies that are listed, is a pain in the ass for the management, right? Because you're facing short-term investors somehow compared to venture funds that are long. You're facing a share price that is moving every day, potentially lack of liquidity. So your share price is just going down every day. It's very depressing, even though you're building up the value of your company, right? I mean, in unliquid market, which is very often the case when you're introducing a startup on the listed stock exchange. I mean, you start to have a reference point of your value that is short term when you're building something long term. So it induces some deception and frustration that shouldn't be there on both sides, the investor and the management. So to be honest, I'm not a big fan of IPOs. Even for the management, right? To some extent, if you want to stay in the company and then keep on building it up, etc., then find yourself a PE fund, minority stake PE fund, etc., generate some EBITDA, and then you buy independence by cashing out your venture investors, but with PE money, right? And remain with long-term view investors and not short-term view, right? Shorter-term view. From a venture fund perspective, my experience is that, first of all, IPO is a window of opportunity you don't have that often, and we're seeing that already now with the SPAC wave that is ending. It was sort of a 2 years momentum. Also been through that in 2007, 2008, Clean Tech 101, with a bunch of companies being IPO'd in the markets back then. But then 6 months after, it's too late, right? You have this window of opportunity, and then you're offloading a lot of whatever company in that space, because suddenly there is a market for that. But it's not liquidity for anyone, right? Even for a venture fund, if you own 10% of a company or 25, then you might spend 5 years selling those 25%. It happened to me back in 2007, IPO of a clean tech company doing wind turbines, 17 times oversubscribed. Even like that, we had 25% after IPO, right, of the company, and then it took us 5 years to sell the 25%.
Wow.
Because lack of liquidity in those markets, etc., and you can't really sell. I mean, unless you find a bilateral buyer.
Right.
But if you start, so yeah, it's not liquidity for us. I'd rather have a clean cut sell. Everyone takes his money. You're happy. The management is happy. If they're willing to stay, then they're welcome to stay with the acquirer and take it to the next level, etc. Or take some P money, but honestly, IPO is not really the best.
And are you making a distinction between deep tech and maybe a SaaS company going public in terms of how long it takes?
Yeah, probably. Yeah. I would agree that with a SaaS model, you can show growth on a constant basis. It's not sort of a stair growth, right? Where like in biotech, you have a 0-1 point in time. Sort of probably software, SaaS, etc. is more linear growth, right? Or sort of, probably.
Or even exponential, yeah.
Or exponential if you're lucky.
Michelle, anything to add to that in terms of maybe differences between the different markets, since Asia, US, Europe all have their own quirks?
Yeah, for sure. But maybe sort of my first comment is that
sure.
I think that that you have full control of your own company. Before selling or going public, I think that's an illusion, right? Because as soon as you raise money from investors, especially sort of venture capital firm, especially, and then you have a board, you are you are being managed, right? You have to answer to the demand or the desire of your investors and board members. So if you really want to have like 100% control of your company, then I would say don't raise venture capital. And so it's just like the different type of people that you need to kind of report and answer to, and so as Bastien said, like once you go public, it's just a different set of investors, and sometimes different a very sort of different agenda or focus. So at least in the US, it's very much like growth oriented, right? In terms of what stock market, public stock market, and Wall Street would value. So, and then it tends to push the company have to take certain approaches. Sometimes maybe it's opting for growth, instead of going towards the profitability. So, which is not necessarily the best for either the company or just in terms of the control that you have, the direction for the company. So I think that, and also as I mentioned really early on, definitely I would never consider either trade sale or MMA exit. It is a worse options, and in fact, I often consider it's the most likely as well as probably the better options for deep tech companies. But yeah, in terms of IPO market, and so it's the the panelists that said it's not super open in the near future. So definitely sort of exit
sounds like you're all
more likely.
You're all on the same page there, and I see that we're out of time. But this was a fascinating conversation, and I feel like we just scratched the surface. But for everyone who's come, there will be a replay that's available on the Hello Tomorrow site, as well as on YouTube. We'll be writing up an article to put all of this information into written format. And as Thomas said, the 8th edition of the Global Summit is open. So if you're interested in that, hopefully you will start your application. Thomas, do you want to add anything else, or did I cover it?
You covered everything. So thank you very much, Renita. Thank you, Michelle, Bastien, Alexander. It was a really interesting conversation. And yeah, let's hopefully see you all back in Paris, so in March 2023 for the Global Summit. And yeah, remember to apply to the Global Challenge if you want to benefit from all the perks that we have for deep tech startups. Thank you very much, everyone, and see you for the next panel discussion.
Thank you.
Goodbye.
Thank you. Bye.
Thank you. Bye.
Bye.